Snowflake is right at the center of today's enterprise AI revolution.
Snowflake is right at the center of this enterprise AI revolution, but the stock is down 70% from the high. Today we are talking all Snowflake. Is there red flags in fundamentals of the company? Two main risks for software as a service companies and why software sector is continue to sell off without catching a break. I will share with you what I believe is the main risk for Snowflake, which is differs from other software as a service company. We will run advanced projections for Snowflake, understand is the company undervalued from valuation perspective. I promise you you'll get tons of value from this video. So with you smashing the like button, let's begin. I recorded the video, I ranked all the SaaS stocks to see who will survive the crash. And from the statistics of that video, most of you guys were searching for Snowflake stock. So here you have it, deep dive on Snowflake. Current drawdown on a stock price on Snowflake is 67%. It was absolute disaster. But in this video, let's find out if this is generational buying opportunity or if we should stay away from Snowflake. Company has two business segments, product revenue, 1.23 billion, and professional services and other revenue. The main segment, product revenue, is basically consumption-based model. So once clients are using Snowflake platform, this revenue will be recorded in this segment, and professional services and other revenue is insignificant, relatively small revenue segment where included consultant, training for customers, and so on. The price for Snowflake is down 70%, but let's see is there a yellow or red flags in financials of Snowflake. From revenue perspective, we can see hyper growth. In 2019, company was generating $96 million in revenue. Fast forward to today, company is generating north of $4.68 billion in a year, which is absolutely mind-blowing growth in just 7 years. Meanwhile, net income continues to go negative and negative every single year, and free cash flow already flipped positive. But later I will share with you what's the reason the free cash flow is positive and net income is so negative. Firstly, before we go any further, I need to make sure you understand the business model of Snowflake and how it runs. So first thing is very important is Snowflake is running on top of the hyperscalers. So Snowflake is built on top of AWS, Microsoft Azure, and Google Cloud. Snowflake is a multi-cloud data operating system, and Snowflake is partnering with the hyperscalers. So Snowflake is paying for the storage and Snowflake is paying for the compute for AWS, Google Cloud, and Microsoft Azure. That's why the gross margin for Snowflake is not 80%, but just 67%, because some part of the expense is going to the hyperscalers. Gross margin is 67%. As I mentioned, Snowflake needs to pay the expense for storage and compute for the hyperscalers. That's why the margin here is lower comparing to average SaaS with 80% gross margin. Free cash flow margin is 23.92%, really nice, but net income margin and operating margin are still deep in the red, still negative margins. So the company is still in hyper-growth mode, and the management believes that they do not want to optimize margins. They continue to spend on sales and marketing, they continue to spend on R&D. They want to grow the business instead of optimize the company for profitability. One of the things I don't really like about Snowflake is the amount of stock-based compensation. Here on the chart you can see the green is a free cash flow and the yellow is stock-based compensation. And as you know, stock-based compensation is an expense which is recorded positively in free cash flow. So you can dilute free cash flow by issuing too much stock-based compensation. This is very nice for the employees of Snowflake because they get huge compensation, but this is not too nice for the shareholders of the company, because for us, what's happening when the company is issuing stock-based compensation is we get diluted, which means the amount of shares outstanding increases, which leads us to owning smaller part of the company, which we see here on shares outstanding. The shares outstanding in 2019 was 238 million shares. Fast forward to today, we have 337 million shares. This is exactly what I'm talking about. The stock-based compensation is diluting shareholders, and long-term shareholders will own smaller part of Snowflake. Meanwhile, the positive thing I can say about the management is that they see that the stock is down 70% and they enabled buyback. You can see in 2025, they already bought back almost $2 billion in their own shares on the open market. And in this financial year, they already bought back $900 million. They are not covering full stock-based compensation. You can see 1.6 billion for stock-based compensation. Meanwhile, they bought back just 50% of that. But still, this is nice to see that management is taking advantage of the lower stock price and buying back stock. Now we are going to be talking two main risks for software as a service companies and what I believe is the main risk for Snowflake. And after that, we will cover on valuation and project return on investment for Snowflake if you invest today. So two main risks for software as a service company. The first one is seat-based model. So imagine, for example, we have a software as a service company, let's say Adobe, and Adobe is selling yearly license for Photoshop. So in this case, you have 50 designers in your company. So Adobe will get 50 seats for Photoshop. But once you adapt AI and once your designers become significantly more efficient with AI, you just need, instead of 50 designers, you just need 25 designers. So in this case, Adobe's revenue will drop 50%. But this does not work exactly like that for Snowflake. Why? It's because Snowflake is a usage-based model, which means the amount of compute you are using Snowflake, you will pay exactly that price. So Snowflake is different from other SaaS companies. Snowflake does not have seat-based model. Snowflake has usage-based model. So this is not the risk for Snowflake. And the second risk for SaaS companies is because now we have Claude Code for Anthropic, and this is absolutely amazing. The normal people without technical background can directly vibe code any website. So there is a saying that, okay, if you are the SaaS company, you can be directly vibe coded in 1 week, and after that you have no mode, you have no pricing power. Now, I believe Snowflake is not easy SaaS to vibe code because Snowflake is a huge SaaS and it's working on top of the hyperscaler. So it has partnership with AWS, it has partnership with Microsoft Azure, with Google Cloud. It's working on top of the hyperscalers and it's running very efficiently. It has a good UX. It has sales team, which is talking to your enterprise team, and they will just demonstrate how you can leverage Snowflake AI and Snowflake capabilities to just, move your business on the next level. So I believe you cannot really vibe code Snowflake in 1 week. So these two main SaaS risks are not really risks for Snowflake, but let me share what I believe is the main risk. Now remember, I told you that Snowflake is working on top of the hyperscalers. So Snowflake is not just competing with average startups. Snowflake is competing with the largest of the largest, AWS, Google Cloud, and Microsoft Azure. And they have their own version of Snowflake. For example, AWS has Redshift, Google has BigQuery, and Microsoft has Synapse and Fabric. So now what we have is that from one perspective, Snowflake is partnering with hyperscalers and they are doing business together. So it's a win-win situation because Snowflake will pay for compute for the hyperscaler, Snowflake will pay for storage. So Snowflake is a partner for hyperscaler. But from another perspective, Snowflake is a direct competitor of these hyperscalers. So I believe this makes Snowflake's mode a little bit fragile because the main partner is the competitor. So if the partner, which is your competitor, decides to damage your business or decides to, increase the competition, to improve their product and lower the price for their product, try to get your customers as their customers, they can simply do that. And this is making the moat of the company a little bit weaker. To see is there any yellow flags or deceleration in the future Snowflake revenue, we can have a look at something called remaining performance obligation. And remaining performance obligation is basically the revenue they are going to recognize over the next 12 months. It has decelerated slightly, but we do not see some kind of deceleration to 30%, 20%, or even lower. So from the perspective of remaining performance obligations, we do not see any significant slowdown in Snowflake's revenue growth. And another very important metric is called net revenue retention rate. This metric is showing the amount of money they are getting from the customers every single year. 125% is a very strong figure and showing that customers is not only staying with Snowflake, but also using more and more every year. And this could be easily explained because the amount of data will grow, the amount of query, the amount of jobs running every day for those business analysis, for those analytics and dashboards for the CEOs, CTOs, to check the KPIs of the company and so on and so forth. So the amount is keep growing, and this is really nice to see as Snowflake shareholder. But what about the valuation? If Snowflake is undervalued at these prices, from the price to earnings perspective, the metric is not usable as for now. The metric is negative because Snowflake is not generating positive earnings. Price to sales was sky high at some time. Snowflake was trading at 221 times sales, and now price to sales dropped to less than 10 times. So from this perspective, we can say that from the price to sales perspective, Snowflake is trading significantly cheaper comparing to historical averages. Price to free cash flow has a spike So let's just move the chart to avoid having this spike. And we can see from 2022, we have historical medium of 90 times price to free cash flow. And now Snowflake is trading twice cheaper than that at 40 times free cash flow. Also cheaper compared to historical averages. But remember that free cash flow is diluted by significant amount of stock-based compensation, as I just showed you previously when we analyzed the stock dilution. Now in InvestKit, you can run advanced projection to understand what return on investment you can get from the company. Here, let us do exactly that. We just click projection for the Snowflake. We will do base case, bull case, and bear case for Snowflake to see different scenarios and which return on investment we can get for Snowflake. So now, moving for the base case, we can see currently Snowflake is growing 29% in the latest financial year. And going to the Seeking Alpha, we will just get the revenue projections estimation from the analyst. Snowflake is very well covered analysts, and they are projecting 26%, 24%, 23%, 21%, 15% for Snowflake. This is exactly what we are going to input here: 26%, 24%, 23%, 22%, and 20% for 2031. Okay, now we need to choose the metric we will be valuing Snowflake based on. We have two choices: price to operating cash flow and also price to earnings. I would choose price to earnings for Snowflake because capital expenditures for this company is relatively low. Now we need to identify the net income margin. Currently, net income margin is deep in the red, minus 28% for net income margin. The company is significantly not profitable. But I believe that the optimized margin in 5 years could be reaching around 18 to 20%. I would not say that they can reach 30% net income margins, because remember, they are running on top of the hyperscaler. So they have additional expense comparing to other SaaS, is that they need to pay for the storage and compute for AWS, Microsoft Azure, and Google Cloud as well. So I believe for the base case, let's assign 18% for the margin, and for 20% we will go for the bull case. And for the price to earnings, so you have the company growing 20% on the top line with 18% margins. I believe 40 or 35 should be appropriate margin for the base case scenario. So having said that, in this case, for the base case scenario, we get 82% within the next 5 years return. Seems not bad at all. Let's save this projection and go to the bull case. For the bull case, we will just generate 26%, and we will say that the revenue will not decelerate significantly from 25% because the amount of data, amount of vibe coded startups will increase significantly, but it will be using Snowflake. So this is very bullish for Snowflake. So if we are projecting 25% until 31, and for price to earnings, we will go with 40 because now we have the company growing 25% with 20% income margin. So I believe 40 is actually quite conservative. So let's go with 45 price to earnings. In this case, we get 185% for Snowflake on the next 5 years. And for the bear case, we will model significant deceleration in revenue: 23%, 20%, 18%, and then 15%. So it's significant deceleration in the next 5 years. And for price to earnings, we will just choose that price to earnings will be just 25, and net income margin will not be too optimized, so it's like 10% net income margin. I believe this is the basically as bearish as you can get on a Snowflake. And in this case, we get down 35% in the next 5 years. Now remember, all this is based on the input I just did right now with you. So for you, please feel free to come to investkit.io and input your own projections. And you can input your own projections not only on Snowflake company, but any company you like. We are covering all companies on UX exchanges. So you can just feel free to come, create account, run projections, analyze financials as simply as we did in this video. We are doing beta tests for InvestKit, and all premium features are available for free. So welcome to join, and I'm looking for your feedback. Now it's really nice. We already have a clear understanding of how the company is operating, how company makes money, what is the margin profile, valuation. We already built the advanced projections, and I will show you one more very useful thing for long-term investor called reverse DCF. The reverse DCF is showing you what implied free cash flow growth is projected for the company. And here we can see that current financial year free cash flow for Snowflake is $1.12 billion. And we are projecting the free cash flow growth for the next 10 years to understand what is priced in today. And we can see that based on the reverse DCF, 16.76% is priced in terms of the free cash flow for Snowflake. Meanwhile, when we are switching to the revenue estimation on our Seeking Alpha, we can see that Analysts are projecting 26%, 24%, and only in 2035, the number is close to 16. So if you believe that the Snowflake can grow free cash flow faster than the growing revenue, because when the company is optimizing for profitability, the free cash flow will grow faster than revenue. It's got operating leverage. So if you believe this is the case, based on a reverse DCF, Snowflake is undervalued at these prices. If you found value in this video, consider subscribing to the channel. On the channel, I do stock fundamental analysis, run public portfolio, and record educational videos. If any of that interests you, welcome to join. Recently, I did a video deep dive on ServiceNow to understand how AI is going to disrupt this company and if this is a generational buying opportunity for investors. If you're interested, watch this video next. Thank you so much for watching. I will see you in the next one.